So now that we have talked about the general requirements for Code Section 351, let's change the conversation and talk about the tax consequences to the parties. So we're going to talk about two different parties, basically, the shareholder and then the corporation. So let's talk about the shareholder first. So as I mentioned, we deal with Code Section 351. There are three things to consider with the shareholder. One, what is their gain or loss, realized and recognized? Two, what is their basis in the shares received? Because remember, the shareholders are contributing property to the corporation and receiving shares from the corporation in exchange. So the question we have is, well, what's going to be their basis in their shares? The shareholders no longer have basis in the property because they don't own the property anymore. The corporation has basis in the property. The shareholder has basis in their shares. And third, what is the holding period of their shares? Holding period. Ooh, let's think back to individual income tax. What does holding period mean? Why do we care? So holding period, if you will remember, matters to determine if you have long-term or short-term capital gain. If the property is a capital property and has been held for longer than 12 months, it will produce long-term gain. If it has been held for less than 12 months, it will produce short-term gain. So the question we have here is, if the shareholder is contributing property, okay, to a corporation, is the holding period that the shareholder's property that they had, is that going to transfer over to the shares? So if they had been holding a piece of land for 20 years and they contributed it to a corporation, are they still going to have a long-term holding period in their shares? Because before they owned land, now they own shares. So these are the three questions to consider for the shareholder. And actually, the corporation really has the same questions. So you could say it from either perspective, but really the first question for corporations, I mean, it's always, they're going to be zero. I mean, there's never going to be any gain recognized for a corporation. So really for a corporation, you're only looking at questions 2 and questions 3. I guess I can go ahead and put that up here. For a corporation, you want to know the basis in the property received and you want to know the holding period of the property. Okay. So let's talk about the shareholder first. When we're discussing gain or loss, realize and recognize, this takes us to Code Section 351, which we read in the last section, says no gain or loss recognized to the shareholder if the requirements of Code Section 351 are met. That's what 351A says. Great. There are exceptions, of course. We'll get to them here in a minute. There are some exceptions which will create gain recognition, and we'll talk about them, for the shareholder. The next question, what is the basis in the shares that's received? This is in Code Section 358. So let's take a look at Code Section 358. 358. The basis of the property permitted to be received under such section shall be the same as that of the property exchanged. Okay, so what that means is we are going to have a transfer basis. So whatever basis you had in your property, you are going to transfer that basis to the shares. So if you will remember in the last session, or maybe the session before, I said that what Code Section 351 does is it defers taxation. So we are deferring tax. The mechanism for that deferral is in Code Section 358, meaning the shareholder takes whatever basis they had in that property and transfers it to their shares, so that later, when the shareholder sells those shares, how much gain is she going to recognize? Basically, the same amount or a similar amount, okay, depending upon the value of the shares when she sells them, that she could have had upon contribution to the corporation. So through this basis mechanism, we are allowing deferral of tax through Code Section 351. Now the last code section to look at is 1223(1), which talks about the holding period. This says the holding period of the property received is determined by including the period during which he held the transferred property, if it is a capital asset or 1231 asset. If not, the holding period begins on the date of the exchange. That language was always very confusing to me. But the reality is it's not confusing at all. All this is saying is we trace the holding period to the asset contributed. So if the shareholder is contributing capital gain or 1231 property, we get what's called a taxed holding period. That means that however long the shareholder held that property, when they receive their shares, they are going to be treated as holding their shares for the same amount of time as they held their property. That is called a taxed holding period. When is it not a taxed holding period? When they are contributing ordinary income property, that's not taxed. Also, cash is not taxed. So if we have a shareholder who is contributing stock that they have held for 6 months to a corporation and receiving shares in exchange, the contribution of that stock is considered to be property, and it is a capital gain property. But because it was only held for 6 months, the shareholder is considered to only hold their shares in the new corporation for 6 months. So we have a taxed holding period. Now, if the shareholder was contributing cash or inventory, then they do not get a taxed holding period. Now, please note that often shareholders contribute more than one type of property. They're contributing cash, they're contributing inventory, capital gain property in the same transaction. Well, then what? Do they have a tax holding period? The answer is partially. You're going to have to bifurcate it according to the fair market value of the taxed property versus the non-taxed property. We'll see an example of that shortly. Okay. Now, let's talk about the corporate level. For the corporate level, when we are talking about gain or loss, realized or recognized, we look at Code Section 1032. Code Section 1032, so you can take a look at it. It's very short. It says, no gain or loss shall be recognized to a corporation on the receipt of money or other property in exchange for stock. Very, very simple. Note, we don't care if the 351 requirements are met. No control group test. The corporation has no gain or loss if they issue its stock for property. That's it. Okay? Or that's it, basically. Very simple for the corporation. The corporation is actually never going to have any gain recognition. The shareholder, there are exceptions to this non-recognition rule, and we will talk about them. Corporation, no. Corporation's not ever going to have any gain recognition because of this Code Section 1032. It doesn't matter if the shareholders qualify under 351 or not. The corporation still has no gain recognition, nothing. The next question for the corporation is the basis. This is under Code Section 362A. So let's take a look at Code Section 362. If property was acquired by a corporation in connection with a 351 transaction, then the basis shall be the same as it would be in the hands of the transferor, increased by the amount of gain recognized to the transferor. So for our basis, we have a transfer basis plus any gain recognized by the shareholder. So that means that if you have a shareholder contributing stock and they have a basis of $10,000 in this stock and it's contributed to the corporation is also going to have a $10,000 basis in that stock. And the shareholder is going to have a $10,000 basis in their shares in the corporation. Okay? What about the holding period of the property? Now we look at Code Section 1223(2), which the language is also a little bit confusing. But basically what this stands for is the corporation is going to get to carry over any holding period of the asset that the shareholder had. So there's not really a concept of taxed versus non-taxed. For the corporation, they just always have a carryover holding period. Because the corporation, please remember, has the actual assets. So the corporation is holding the actual assets. So if the corporation is holding a piece of land that was held for 3 years by the shareholder, the corporation is treated as holding that land for 3 years. If the shareholder contributes cash, the corporation is treated as holding that cash basically the day that they receive it. It doesn't matter, right? So, because the corporation has the actual assets, all we say is the holding period goes with the assets. It carries over with the assets. Whereas the holding period of the shares for the shareholder transfers from the assets. Understand the difference between carryover and transfer. Carryover means we are flowing with the assets, staying with the assets. Transfer means The shareholders now hold a different kind of property than they held before. Before they had cash or land, now they hold shares. But we are transferring the attributes from those property to their shares. So it is a little bit different, okay? But it honestly often feels exactly the same. So, okay. Another important code section for the corporation and for the shareholder too, it really applies to both. Is code section 362E. So let's take a look at code section 362E. So if you will remember, the general rule for corporations is right here. They get a basis in the property of whatever's transferred, or I guess technically you would call this a carryover basis, right? Because the basis of the property is carrying over from the shareholder who held it before. Okay, semantics, honestly. In practice, nobody ever cares whether you say the word carryover or the word transfer, but it may help you understand it a little better. So, okay, so the general rule is the corporation gets a carryover basis. There is an exception, and this is found under code section 362E. So let's take a look at 362E. This is on page 86 of my code and reg books. If any transaction described in subsection A or B, there would be an importation of a net built-in loss, the basis of such property will be its fair market value. So what this says is if we have a net built-in loss upon contribution, the corporation's basis is the fair market value. So, some things that are very important to know about this code section. This word, net. This code section is calculated in the aggregate on a shareholder by shareholder basis. What that means is if you have one shareholder and they are contributing 3 or 4 properties, we are going to add up all of the bases of those properties and the fair market value of those properties and determine if they have a net built-in loss. If the answer is yes, then we have to worry about code section 362E. Now, there is even an exception to the exception. There always are. That is if the election is made. So there is an election which basically allows the corporation a carryover basis, but the shareholder receives a fair market value basis. So we're just switching which party is going to be able to take it. And the whole rationale behind this code section is the Congress is not allowing the duplication of losses. So instead of going from one lost property, you're effectively creating 2 lost properties. One, the shares that the shareholder have in the new corporation, and 2, the property that the corporation is holding. So what we're trying to do with this code section is only allow one level of loss. And know that the loss doesn't actually happen now. It would happen later when the property is actually sold or the shares are actually sold. Because remember, in a Code Section 351 transaction, there is no loss recognition. Okay? We are talking about later. Okay? But 362E affects the basis calculation now. Okay. Note that if you do have to make an adjustment, the adjustment is among the properties in proportion to their respective built-in losses. So we're going to allocate according to respective built-in losses. We'll see an example of this in a minute. All right? So I'm going to pause it, and then we're going to come back and do this problem.